Hello everybody. Today we're going to talk about how the very wealthy invest for income. But let's be very clear about this right up front. This is not a life insurance or an annuity sales pitch. That's not how the wealthy invest for income. I know you've heard those constant radio ads pitching a free book or a seminar. And you probably know that those ads often lead to a pitch for a life insurance policy or an annuity. Well, that's not us. That's not our message. What we're going to tell you about today are very conventional, you could even say normal, investment plans that are designed to produce recurring cash income, income that you can receive every month, and income that can increase with inflation year by year, every year. My name is Jim Farron. I am a certified financial planner with 35 years experience counseling with clients about their retirement future. And this is Farron Capital Advisors in Pleasant Grove, Utah. We have packed a lot of information into this short video webinar. First, we will look closely at Mitt Romney's personal tax return, the one he released and made public. We'll examine dividends and qualified dividends. And we'll introduce 7 of our retirement income strategies. And we'll do this all in about 20 minutes' time. Now, the fact that you are watching this tells me that, 1, you are an investor, or at least a saver, and you have accumulated some funds to support your retirement future. You might already be retired and you need to draw income from your investment portfolio, but you don't want to be depleting your principal, selling some of your shares every month to generate your monthly cash income, or what we call eating your seed corn. Or you might not be retired quite yet, but you are approaching it, and you want to plan your strategies for generating your retirement income without having to deplete your principal. And you are no doubt already very aware that evenly with modestly rising interest rates today, 1 or 2 or 2.5% bank interest just doesn't cut it. Every retiree knows this, but many still leave large sums in the bank at low interest rates, even drawing and spending all their interest income and some of their principal each month, slowly eroding their capital, hoping they don't run out of gas too soon. They do this because of their perceptions of safety and risk, and because they might not know what else they can do. Today we are going to show you some alternatives, options that make sense to us, strategies often used by the very wealthy. So let's talk about Mitt Romney. I like to talk about Mitt because he is rich and famous, and he made his tax return public so we can see what he is doing. Do you remember when Mitt was running for president in 2012 and he was criticized for paying taxes at a lower rate than Warren Buffett's secretary? Well, as it turns out, that was true. And what we learn about taxes from Mitt's tax return is both interesting and valuable. But what I really like is what we learn about how Mitt invests for retirement income. Mitt is certainly one of America's wealthy class, and he invests like it. The first thing to notice is that Mitt received no wages or salary in 2011. This is the first key: wages, salaries, business income, the compensation for people still working. It's all taxed as ordinary income, taxed at your highest rate. But Mitt had no wages in 2011. In that sense, you could say that Mitt was retired. But he did have lots of retirement income. His total income in 2011 was $13.7 million, and his total federal tax was $1.9 million. Mitt's federal tax bill for 2011 was just over 14% of his total income. But let's look a little closer. Mitt had over $3 million in taxable interest. Most of this came from government bonds. This suggests that Mitt had a little over $71 million in U.S. government bonds. Today, if you have, say, $100,000 in government bonds, you might expect about $3,000 per year of interest income. Mitt also received dividends of $3.6 million in 2011. But notice that $2.2 million of that amount, or more than 60% of his dividends, are considered qualified dividends. What are dividends? And what are qualified dividends? Well, that is another key. It is the golden ticket we have been talking about. Mitt certainly used them to his advantage, and so can you. Dividends are the cash income that profitable companies pay to their shareholders. Companies are in business to make a profit, and when they make a profit, there are only a few things they can do with it. They can keep it to reinvest in the company to make it bigger or better, or they can pay it out to the people who own the company, the shareholders. Great companies that have a proven track record of success can pay you regular dividend payments from their profits, monthly or quarterly. And they could potentially grow their profits year after year. And as they grow their profits, they can raise their dividend payments. That means a shareholder like you could collect recurring cash income for retirement that could actually increase over time. Now, dividend payments are not guaranteed, but there are companies that have long records of paying their shareholders a dividend every 3 months for 30 or more years. And many have actually increased that dividend payment every year. Notice we aren't talking about the stock market going up or down. No, what we are talking about are companies that have been in business for a long time that pay a portion of their profits to their shareholders as a dividend. For illustration, let's look at a real-life example of a company that you know that pays dividends to its shareholders. Here's a chart of Chevron's price charted over the last 30 years. Notice the price goes up and down a lot. Sometimes it even crashes. But look at a chart of Chevron's dividend payment. Over the same time frame, the last 30 years, the dividend hasn't crashed. In fact, it has gone up and up and up some more. Well, let's put the two charts together. And here's the point you'll want to remember. The price of the stock can go up and down a lot, but the dividend doesn't necessarily follow the stock price. Dividend payments and stock prices are two very different things. Dividends are declared by the board and are paid based on the profitability of the company, regardless of what the stock price is doing, either rising or falling. But just notice this, the dividend can be constant, and it can even increase, no matter if the stock price is rising or falling. Look at the gray shaded vertical bars on the dividend graph on the right. Those mark U.S. recessions, 1990, 2001, and the Great Recession of 2007 to 2009. Notice that the dividends didn't drop off during recessions, but still grew. That is really good for retirement income. Yes, the price has been volatile, and if you had to sell your shares to collect your income, you would have been, and should have been, pretty nervous. A market crash could really hurt you. But if you are living on the dividend payments, then your income has been constant and increasing almost every year. You don't have to sell in a down market. You might not sell ever. You can be very patient with volatile market prices. In fact, at some point you might even stop worrying about volatile markets because your income is so consistent. Now, this isn't a recommendation that you buy Chevron. As an investment advisor, I can only make recommendations after I know you, your needs, and your situation pretty well. I speak of Chevron because it illustrates an important truth about investing, which is dividend income can rise even when stock prices are volatile. And besides, Chevron is just one company, and I would be afraid to own just one or even just a few companies. But, and here's a retirement income strategy. I really like the idea of owning many quality companies, 10 or 20 or more, each one sending me a dividend check every 3 months. Which takes us back to Mitt Romney. Mitt's tax returns showed us over $3.6 million in ordinary and qualified dividends. Ordinary dividends are taxed as ordinary income at your highest tax rate, but qualified dividends are taxed at much lower rates. Mitt had both ordinary and qualified dividends in 2011, and both make good sense for retirees, but there are big differences in how they are taxed. Well, let's not get too lost in the weeds of taxes here, but to me this is just stunning. Dividends paid by many U.S. corporations are called qualified dividends, and they get special tax treatment. Qualified dividends are taxed at a much lower rate than ordinary income, like bank interest. In 2011, Mitt had over $2.2 million in qualified dividends. So, if your regular federal tax rate on your ordinary income is 10% or 12%, then your qualified dividend tax rate is 0%. That's tax-free. If your ordinary income tax rate is higher, then your qualified dividend rate is held to just 15%. And if your total income is even higher and otherwise taxable in the highest brackets of 35% or 37%, then your qualified dividends are taxed at a top rate of just 20%. For some upper income taxpayers, that represents a nearly 46% reduction in their federal tax rate. So I said earlier that dividends are the golden ticket of retirement income, and qualified dividends are the best. Qualified dividends are retirement income that can be higher than bank interest, potentially a lot higher. It is income that can increase each year, and it is income on which you can pay a lot less tax. And that's why I love qualified dividends. Qualified dividends are not just for billionaires. They can be a powerful investment strategy for all of the rest of us too. So if you'd like to explore how qualified dividends can work for you and how much tax you might save, then let's jump on a strategy session phone call together. Just click on the scheduler link below. There is no cost or obligation for the call. We have talked about investing for bond interest and for dividend income, and qualified dividend income in particular. We have talked about companies with long track records for paying their shareholders regular dividends that can rise every year. And we looked closely at one example, Chevron. But nobody should put all their money into any one company or in any one strategy. So we use at least 7 different strategies when we build our clients' retirement income portfolios. And real quickly, here they are. First, we build portfolios of high-quality, blue-chip, dividend-paying companies. We talked about Chevron, but I can think of dozens of others. Next, we like preferred stocks for their preferred dividend income. We like real estate investment trusts, or REITs. These are companies that own income-producing real estate. We like REITs that invest in housing, or storage units, and warehouses. Think of all those online purchases that are made today. We call it the Amazoning of America, of the world really. All that merchandise flows through a warehouse somewhere. Those warehouses are often owned by a REIT investment that passes that income through to our retiree investors. And speaking of online purchases in the internet, we often speak of the cloud. Well, guess what? The cloud is not in the sky. It's in buildings, computer data centers around the world, and those buildings are often owned by investors who collect rental income. We also like REITs that invest in healthcare properties like skilled nursing facilities, assisted living centers, and hospitals. The REITs don't actually operate these facilities, they just own the real estate and collect the rent. Aging baby boomers, now ages 52 to 72, provide a nice demographic support for this type of income-producing investment. Now, REITs are a special corporate structure that allows them to not pay income taxes at the company level if they pass the bulk of their profits through to their shareholders as a distribution. Since they pay little or no income tax and they pass their profits through to their investors, they tend to pay a fairly high level of income. And that's really good news for retiree investors. Next, we like oil and gas pipeline companies. We have thousands of miles of oil and natural gas pipelines in this country, and they are owned and operated by pipeline companies. These companies are largely structured as master limited partnerships, or MLPs. Similar to REITs, MLPs pass the bulk of their earnings through to their shareholders as monthly or quarterly distributions, and that spells high current income for investors. We also like business development companies. These are companies that provide financing to other companies. In a similar way, they pass the bulk of their profits through to their shareholders as a distribution. Now, this was Mitt's business before he got into politics, so it's no surprise he still receives substantial dividend income. We like closed-end funds, or CEFs. These are unique mutual funds that can invest in stocks or bonds that produce high income. But the magic is that these funds can often be purchased in the market at discounted prices. A discounted purchase price means an even higher income for the investor. And finally, bonds can balance a portfolio and produce income as well. Bonds are issued by companies and by the federal government, as well as by states, cities, universities, and more. Interest received on corporate bonds is taxable, but interest received on municipal bonds can be totally tax-free, and that's a real help to retirees. You can maybe imagine how it might feel to be retired and to have a broadly diversified investment portfolio that includes blue chip dividend stocks, preferred stocks, real estate companies, pipeline companies, closed-end mutual funds, bonds, and more, all paying you regular recurring dividend income. The income not only repeats itself over and over again, but it can increase each year. And this is key. You never have to sell your shares in a down market in order to collect your monthly cash deposit to your bank account. At some point you start to relax, knowing your income is diversified. You like to see the market go up, but you know it doesn't have to still provide you your monthly income. Market swings no longer worry you. Now that is a feeling of retirement security. So, which strategy is right for you? Probably all of them. When we build a portfolio for a client, we often draw on all of the strategies, each one weighted differently according to how aggressive or how conservative the investor needs to be. To some degree, and in different proportions, every retiree investor may want to tap into all 7 strategies. We build these portfolios with 4 goals in mind. First, we certainly want to be diversified. Someone asked recently if this strategy is safe. Well, it might not be if you put 100% of your money into just one company or stock. But if we put just a little, like maybe 1% or 2% into each of 50 or 100 different companies, then you can be more assured. Second, we want to generate cash dividends. We want to produce monthly cash income that you can spend without ever having to sell your shares. Next, we want the portfolio to grow in value over time. We won't obsess too much over shorter-term volatility or fluctuations, but we still want to see long-term capital growth. And finally, we want to minimize the burden of income taxes. Today's retirees live longer. They play harder. They travel. They serve. They live life to the fullest. At least that's what they want to do. If we are constantly fretting over low bank interest rates or worried about the stock market rising or falling or crashing, then it is very hard to fully enjoy your retirement lifestyle. I think of my friend Dave. Dave is one of our clients, but years ago we were college buddies at BYU. Dave became an airline pilot. He had a great career and a great family. As you might guess, he traveled the world many times. But last year, Dave turned age 65. At 65, the FAA says you are through flying. You're retired. Dave arrived at that point that most of us will reach one day. And for many, it is a sobering point. It is the point where you can no longer produce the income you need. Rather, you have to begin to rely on the income that your investments can produce. All through our careers, we save, we invest for long-term growth, but we live on our wages, our salaries, or our business income. We keep an eye on the investment bottom line, but pay relatively little attention to the cash dividend income that the portfolio produces. But when retirement arrives, all that changes. Cash income becomes a paramount concern. So, we rolled Dave's 401k into an IRA. Dave is now invested in all 7 of the strategies. He is invested partly for growth, but largely for income. The design goal was simple: produce enough recurring cash dividend income to supply Dave with the monthly distributions that he needs, and do it with cash dividends, without having to sell any seed corn shares. Dave's dividends are swept monthly into his bank account, and I told him to just spend it. Spend it without worry. The stock market will rise and fall with good days and bad days, but it doesn't matter. What matters is that every month the cash he withdraws reproduces itself. We aren't selling shares to generate his income. We are harvesting his dividends every month. Do you think Dave is happy? I assure you he is. So could this be you too? Your decisions are now these. How will you live in your retirement years? Will you risk spending down your principal? Or will you begin to invest like the billionaires, adopting a managed income strategy? If you want to build out your retirement income portfolio, you really have two options. You can do it yourself, or you can work with us, the Retirement Income Specialists. For over 35 years now, we have helped our clients to prepare for and to prosper in their retirement. It's what we do. It is our passion. So I invite you to schedule for yourself a free strategy session phone call with me. That call will take about 20 to 30 minutes, and it isn't a sales call. The call is about you. We'll talk about your situation and resources. We'll talk about your desires, your goals, and risk tolerance. We'll discuss your needs for retirement income and how you can meet those needs. And we'll talk about your tax profile. And we do this at no cost for you. We do this because we can't offer specific investment recommendations until we know you better. And you wouldn't want our investment recommendations until you know us better. This is your no-cost, no-obligation way to find out if we can meet your needs. So it is very simple. Just jump on my calendar and schedule yourself for a no-cost strategy session phone call. I hope this short video training has been a good start. I hope you found it useful. So thanks for watching, and I look forward to hearing from you.